So you're gearing up for your MBA, maybe even thinking about a finance specialization, but your background isn't in finance at all? Well, don't sweat it. You're exactly who this is for. We're going to build your foundational toolkit, focusing on the core ideas you absolutely have to know to nail those interviews. So where do we start? Well, it all begins with learning a new language.
Look, if you want to succeed in business school and pretty much anywhere after, you've got to speak the language. And that language really is finance and accounting. Don't think of it as just a bunch of math. Think of it as the grammar you'll use to understand any company's story. Getting the hang of this isn't just about passing an exam, it's the key that unlocks your whole MBA journey. All right, here's our game plan. We'll start with the basics of accounting, the grammar. Then we'll get into the 3 main stories every business tells. After that, we'll dig into how to actually analyze those stories, see how it all connects, and then wrap it all up in a neat little toolkit you can take with you to your next interview. First things first, accounting. Let's get comfortable with the fundamental grammar of finance. I know. That sounds a little textbooky, right? But the 2 words I want you to focus on are summarizing and interpreting. See, accounting isn't just about plugging numbers into a spreadsheet. It's about making sense of those numbers to tell a story. And that's the art, that's the skill that'll really set you apart. Now, this is a big one. People mix these 2 up all the time. But here's an easy way to think about it. Bookkeeping is like writing down all the words and sentences. It's the how. But accounting, that's about crafting those sentences into a story, something that explains the why. For your MBA, you need to be the storyteller, not just the scribe.
Okay, so if accounting is the language, then the financial statements, well, they're the big chapters in a company's book. These are the 3 core stories that every single business uses to talk about its performance and its health.
First up, the balance sheet. The most important word here is snapshot. Seriously. Imagine you whip out your phone at the stroke of midnight on New Year's Eve and take a picture of a company's finances. That picture, in that one single moment, shows everything it owns and everything it owes. That's the balance sheet. And the balance sheet follows one simple, unbreakable rule. Assets have to equal liabilities plus equity. Always. Think about it this way. If a company has a new $100,000 machine, that's an asset. The money had to come from somewhere, right? Maybe they borrowed $60,000, that's a liability, and the owners kicked in $40,000 of their own money, that's equity. See? $100,000 on both sides. It always has to balance.
All right, next is the income statement. So if the balance sheet was a snapshot, a photo, this is the video. It doesn't show you just one moment. It shows you the action over a whole period of time, like a quarter or an entire year. And its whole purpose is to answer one simple question. Did the company actually make any money?
The income statement is like a waterfall. You start at the very top with all the money that came in from sales. That's your revenue. Then you subtract the direct costs of what you sold, the raw materials. That gives you gross profit. From there, you keep subtracting all the other costs of doing business, like rent and salaries, until you get all the way down to the bottom line, the actual profit.
So you might be thinking, wait, why do we need a third statement? If the income statement shows profit, isn't that good enough? Well, and this is a huge concept for your interviews, profit is not the same as cash. A company can make a huge sale and look really profitable on paper, but if the customer hasn't paid their bill yet, there's no cash in the bank. The cash flow statement is the truth teller. It answers the question, okay, that's a nice profit, but where did the actual cash go? What's so cool about this statement is that it sorts all the cash movements into 3 simple buckets. You've got cash from your day-to-day business, cash you're spending on big investments like new factories, and cash you're raising from banks or investors. When you look at all 3 together, you get this incredibly clear picture of how a company is really running. Okay, we've got the statements down. Now for the fun part. Let's move on to reading between the lines. This is where you go from just reading the story to actually analyzing it, and this is what will impress your interviewers.
Ratios are basically just tools that let you ask smart questions. Think of them as different lenses. Each one of these categories helps you answer a very specific question, like, can the company pay its bills this month? That's liquidity. Is it actually making money on its sales? That's profitability. Knowing which lens to use for which question, that's the key.
Let's zero in on a really important one, debt to equity. If an interviewer asks you to talk about a company's risk, this is your go-to tool. It just compares how much money the company has borrowed versus how much the owners have put in. A higher number means the company is relying more on debt, which is risky, right? Because you have to pay the interest on that debt no matter what. Quick tip though, what counts as high? totally depends on the industry. A utility company can handle a lot more debt than a little tech startup.
And now for a superstar profitability ratio, return on equity, or ROE. If you're an owner of a company, this is the number you really care about. It answers the question, for every single dollar I invested in this place, how much profit did you make for me? A higher ROE is a great sign. It means management is really good at using the owner's money to make more money.
Okay, so we've got the statements and we've got the ratios, but here's the next level move for your interview. Understanding that none of this stuff exists in a vacuum. It's all connected. And there's a brilliant framework called the DuPont analysis that shows you exactly how.
This is where the magic happens. The DuPont framework basically says, hey, that big important ROE number, let's break it down. It shows that ROE is driven by three things. First, how profitable are your sales? That's profit margin. Second, how good are you at using your stuff, your assets, to make those sales? That's asset turnover. And third, how much debt are you using to pump up your returns? That's leverage.
And boom, there it is. You just multiply those three things together to get ROE. This is so powerful because it shows that a company can have a great ROE for different reasons. Maybe it has huge profit margins, or maybe it's just incredibly efficient. This formula is the bridge that connects the income statement, where we find our profit, and the balance sheet, which tells us about our assets and leverage. Understanding this connection is a total game changer.
All right, let's bring it all home. We're going to package everything we just talked about into your personal interview toolkit.
If you remember one thing, make it this: the why, what, how framework. For any finance term they throw at you, just walk through it. Why does this thing even matter? What is it in plain English? And how do I use it to figure out if a company is a good bet? Just keep that in your back pocket. Remember, accounting is the language, the three statements are the story, and the ratios are how you analyze it. You've got this.
So, I'll leave you with a classic interview question to chew on. Imagine two companies have the exact same return on assets. How could their return on equity be totally different? The answer is hiding in that DuPont framework we just talked about. If you can figure that one out, you're not just memorizing terms. You're really starting to think like an analyst. Good luck out there.